who came up with the term or the name market wizard? Was it you or?
I say I came up with it. Possible my wife may have come up with it. I'm not sure. So the best material in the books typically comes from going off on tangents on something they say. The interview only gets you about 2 or 3%. The actual transcripts will put people to sleep. The reason the books work is because it has the essence of what was in the interview, but it's in a nice readable format. You can get ideas out of books from the internet and all that, but ultimately you have to find things that you're comfortable trading. Always start with what for you is a relatively small amount of money that you can lose and it won't change your life.
Welcome to the In the Money podcast. Today we have with us a man who needs no introduction whatsoever, especially for those who trade. Jack Schwager. Thank you for taking time out, Jack. It's indeed an honor to have you with us today. In fact, 8 years back, our CEO Nitin spoke with you, and we are glad to have you with us back again. If I think about it, I don't know a single trader around me who hasn't read your books, or rather who hasn't been inspired by the stories in them. I would say if Wall Street has a storyteller, it is you. But many wouldn't know you've been much more than just a writer. You spent a few decades as director of futures research at some of Wall Street's leading firms and most recently at Prudential Securities. You also partnered with TradeShark to build a set of proprietary trading indicators, and you co-founded FundSeeder, a platform to discover trading talent worldwide, which was recently acquired. And through all of this, you authored upwards of 13 books over a 4-decade career and interviewed close to 85 of the world's greatest traders along the way. The most recent of these books is Market Wizards, the Next Generation, co-authored with George Coyle, which came out just last month. For those of you watching, if you haven't got your copy yet, we'll have the link in the show notes. Jack, thank you again, and thank you for taking time out for us.
Sure.
So I would like to start with, question about how you got started in markets. And I was listening to one of your other podcasts where I understand you got into markets quite by accident, where after your graduation, you put up an ad in a newspaper and got started. Can you take me through that? What exactly was it like?
Sure. So, like many things in life, luck or fate has a lot to do with what happens. And I had no thought or intention of being in markets. And it was just by coincidence that, as you mentioned, but this is quite a while ago. This is all the way back in 1971. I don't even know if it still exists anymore, but at the time, you could put ads into, position wanted, and the cheapest ad you could buy in the New York Times, made like one sentence, basically saying something along the line, MA Economics, minor mathematics, looking for an analytical job, something along that line. And I got most of the responses I got were really people trying to hook you to do pyramid sales and whatever but I had one legitimate call, and that legitimate call was from a brokerage firm that was looking to replace an analyst that was leaving. And I went in for the interview, and ultimately the director had the finalists write an article he wrote a column for Barron's at the time, Commodities Corner, and he had each of the finalists of the interviews write a piece, which he then used himself as background to write the articles. But anyway, my article got passed around, and the articles got passed around the office, and supposedly everybody said, pick this guy. And so I wrote my way into the job, yeah.
Oh, lovely. So, but over years, you were a research director, but what exactly was that role like? What were you doing on a day-to-day basis?
I was always never just the director. I always covered certain markets myself, and this is why I was in the futures market. So initially, I covered sugar and cotton and cattle and hogs, which were just by virtue of the fact those were the markets that my predecessor being Michael Marcus, who ended up being chapter 1 in the first book. But those were the markets he covered, and so that's what I was assigned. Later on, a few years later, I went out and looked. I was very underpaid, and I looked for another position and found one very quickly. And from that point on, I mean, I was again director of research, but within a few years, I started doing all the technical analysis as well as the research director. And as research director, you basically are supervising. At the time, brokerage firms put out reports, and it was a different world. And so I would either write them, or if other analysts wrote them, I would kind of rewrite them so they read well and so forth.
Okay. So at that time, Jack, how did your understanding of fundamental research versus technical research evolve? I mean, did you start with fundamentals or did you start with technicals? How did that happen?
Yeah, I started with fundamental. I came from a background of, I graduate school, graduate degree in economics. Back in those days, markets were not covered, and let alone futures markets. And but anything that was remotely similar that I would have been exposed to would have been from the fundamental side. I never in my life had encountered anything to do with technical analysis. And coming from a economics type background, you sort of come in prejudiced and biased towards fundamentals, and kind of not believing that there's anything to charts and stuff like that. And it was only through experience an analyst who worked for me at the time, early on, who was at the time the technical analyst, and before I switched firms and ultimately became a technical analyst myself, but he was the one who exposed me to technical analysis. And I discovered that, I was very skeptical, but I noticed that of all my analysts, he was the only one who was predominantly making correct calls and was predominantly profitable. So all the fundamental analysts didn't do that hot, but he did better than any of them did. So I kind of, being open-minded enough, asked them, okay, tell me what you do and so forth. And we worked in the same office, and we were friends and so forth. So it was through his influence and through his initial mentorship on charts. And yeah, he was a chartist, and that was my exposure to it. But it was through his influence that I really became influenced in technical analysis. And the key for me was that I discovered that fundamental analysis was very difficult to apply in a timing sense, at least for me, to markets, because in fundamental analysis, the more the market goes against you, if nothing has changed, logic would say you should buy, if you're long, you should buy more, because if wheat's a good buy at 5 and nothing changes and it goes to 4, it's an even better buy. And so it worked inverse to good money management. Whereas technical analysis, if you're wrong, any approach you're using, the market would, if you were honest to the reason you got into the trade, the methodology itself, the technology itself, would dictate that you should be out. For example, if you were going something because, let's say you bought a breakout because you expected the market to keep on going, or you bought within a trading range expecting a breakout, and it goes the other way, then your reason for being in the trade is violated, and you have a reason for getting out of a trade, which is exactly the opposite of technology. Even if you're a counter trend trader, your counter trend would be based on, okay, I think the market's going to hit resistance. It's gone too far. It's reached its objective. It's going to should have resistance because of A, B, and C. And therefore, if it keeps on going past that area, your reason for being in was violated. So even as a counter trend trader, technical analysis would give you a reason to be out of your trade if you're wrong. So I found it very easy to marry technical analysis with money management, which by that time I had learned was essential. And so I ended up ultimately going from 100% fundamentals to 100% technical.
Between then and the writing of your first book, how many years or how long did it take for you to get a hang of technical analysis, and then you went on to write a book about futures?
Well, the first book was was a book called The Complete Guide to the Futures Markets, which was written. I wrote it in '83, I believe, and it came out in '84. I took a year-long sabbatical to write it. My motivation was I didn't think there was a good book on analysis in the futures markets, not a fully comprehensive one, and I thought I could do it. So I took a sabbatical to do that book. And this was pre-computers, and it was an intensive labor at that point. If you think of, I mean, it's a near 800-page book, and with analysis and charts and all of that, which was nothing could be computer generated at that point. And so, besides the writing of it, it was also a matter of just even doing things like if I had to do regressions, I had to literally do them by hand. It wasn't like I had a program and ran a regression. I literally had a calculator and did the regression by hand. So it was a tremendous chore, but I got it done in about a year. And yeah, that was my first book. Yeah.
Lovely, lovely. So after this book or around this book, did you also get a sense of which approach towards markets, be it systematic or discretionary? Did you have a sense of what works better for you, or what works? What was your idea then about these two ways of looking at markets?
That's a good question. Basically, the book really covered both sides of it. Lots about discretionary, lots about systems, and lots about how creating futures. Like stocks, you don't have a continuous series for testing, and various aspects of testing systems and so forth. So it had both elements. As far as myself, I initially started with charts. I eventually went purely systematic because I thought that was a good way to get emotions out of it. And for a number of years, there were some systems that I designed along with an analyst that worked with me that ran on a brokerage firm platform. And every morning there would be like 3 systems that would generate signals, and that ran while I was there. So and I also was involved at that point in a small CTA that used systems and so forth. So I had that exposure. I ultimately, for myself, discovered that systems didn't exactly get rid of emotions, because let's say you're a trend follower. So you have the irony here, and I don't know if it's still true. I haven't done system testing for quite a while, but whenever I did it, and multiple times, it always came out that the longer term systems were ultimately more successful. Now, I believe that true for a couple of reasons. One is that they're very difficult to trade because you have to kind of ride big drawdowns. The reason they're better on a long run is, even though you give back a lot of money when a signal reverses, you eliminate a lot of whipsaw trading. So on balance, at least I would bet that it's probably still true, but I haven't done testing in recent years. But I would assume it's probably true. Certainly at that time, it turned out that the benefit of missing all those whipsaw losses outweighed the downside of suffering larger retracements when the trend truly reversed. But in any case, so the system that worked better, you had to kind of ride through significant drawdowns, and that's emotional too. I mean, you commit to a system, you commit to following it, but you have to kind of wait there for a market to retrace 20% and before you get out, or whatever it might be. And so I found that uncomfortable too. So I ultimately ended up just purely technical, based off of charts, and being able to select my stops discretionarily, which I could then choose to be relatively close and more comfortable to trade.
Okay, I'll come back to this when we talk about market visits. But thanks. And around, I think, a year or two later, you wrote your first market visits book. How did that idea happen?
Yeah. So I don't know exactly when I got the idea, but it was obviously after I wrote my first book. And it was because I happened to know some great traders. As I mentioned, Michael Marcus, who was a trader I replaced as a analyst, he was still in New York for a few years. And we met when I was coming in and he was clearing his desk. And we got together for lunch every few weeks or whatever. So I knew him, and through him, he went on to then become a great trader, and he ultimately went to Commodities Corp, which was one of the very early uh, firms that gave allocated money to traders, uh, and they had given him a $30,000 account, and he ultimately turned it into 80 million. But anyway, I knew him. He had hired Bruce Kovner, so through him I knew Bruce Kovner. So I knew a few great traders, and I also thought, gee, if I was ever going to do another book, a book on kind of interviewing these great traders would be a good idea. Would be fun. But I was a research director, and that's a more than full time job, so I just didn't do it. Then one time I got invited to a lunch by uh, an editor for another publishing firm, and they were familiar with my complete guide. And that book had done, for what it was, for that type of book, it had done reasonably well. I mean, that type of 800-page analytical books don't become huge sellers, but it had done as well as you could do for a book like that. And they wanted me to do a whole series of books where I'd be the editor in chief and do a do a book on gold, do a book on wheat, do a book on one book on each market and stuff like that. And I said, I've been there, done that. I don't want to, not interested. I said, if I ever wrote another book, and I mentioned the market wisdom idea, and because I wanted to reach a larger audience. And they said, sure, why don't you do that? So that was the catalyst. I wanted to do the book. I just didn't have time. And I ended up doing it nights and weekends. Back those days, I was a lot younger, obviously. And when I was young, I had tremendous focus. I mean, that was one of my strengths. I could literally stay up through the night and be totally laser focused on whatever I was writing and get stuff done. And I was productive because of that focus. And like I was able to do the book while still working a more than full-time job. But it really required sacrificing weekends and a lot of sleep.
Hmm. Would you have to travel to interview and make notes and then come back to your desk and make those edits? How did the whole process work?
Okay, so I've used the same. The first book was successful, and if it's not broken, don't like the old cliche. If it's not broken, I forget who said it originally, but if it's not broken, don't fix it. And so the format and the approach I used for the first book had a lot of elements to it, and it worked well. And I've kind of maintained it in every subsequent Market Wizard book. So the process essentially was, I would go and interview these traders. I would interview them as long as I could, as long as they would tolerate it, and as long as there was anything left to talk about. Now, in some cases, like in Michael Marcus, I ended up interviewing them a whole day and then staying overnight and interviewing the next day. And there are a number of cases where there were literally as much as 10 plus hours of interview, and which leads you with a lot of material that you have to kind of mold. And in some instances, the interviews were much shorter. And the other thing I do was to try to do it as a conversation, not to go in and have a list of questions, but rather to have a conversation, to listen to what they were saying, because a lot of times things that I wouldn't have normally asked, but something they said triggered, was interesting, and that led to a tangent, and that led to a tangent. So the best material in the books typically come from going off on tangents on something they say. So that was something I always did. And then I discovered, and I didn't know this, but I discovered very early, right in that first book, that the interview only gets you, now I'm not exaggerating here, the interview only gets you about 2 or 3% of the way there. The other 97% is taking all that material and turning it into a readable chapter. So that's where the real work was. And I would literally I would go through the tapes. I even had them transcribed and would have hundreds of pages per interview to go through. And I would basically, my first go at it, whether I was looking at a transcript or listening to the tape, would be to strike out everything that I thought didn't provide any information that was useful or wasn't interesting. So it had to drive a narrative or it had to provide some insight about trading. But if it didn't do one of those two things, I struck it out. Then I was left with the rest of the material, and then it was a matter of kind of cleaning it up. And the order of the conversation doesn't necessarily and usually does not match the ideal progression of a readable chapter. So you might have the same topic come up 4 times in the course of hours, and I would then pull all that stuff together into one section. And so ultimately, I would use the base material, the raw material, and then fashion that into the chapter, trying to do two things at one time. One, to be true to what the trader was trying to say. I say try, or if I'm lucky, what he said. But the way we speak is often doesn't translate very well to the written page. So you always have to almost always have to fix all these run-on sentences and there's a whole sorts of problems or things that are started that are never finished and all of that. But basically, I was trying to be true to what the trader said, use their actual words whenever I could, and then extract all of that from the chapter, from the interview, and put it into a readable chapter. So the actual transcripts will put people to sleep. The reason the books work is because it has the essence of what was in the interview, but it's in a nice readable format.
I agree. And who came up with the term or the name market wizard? Was it you or?
No, I say I came up with it. I don't know. It's possible my wife may have come up with it. I'm not sure. I don't remember where it came from, but it would have been me and my wife. I don't remember like a moment in time where I had I just knew by the time I spoke to that publisher that I had the name in mind. But whether I originally thought of it or my wife suggested it, I don't remember.
Cool. Okay. So, and were there instances, especially the first time when you wrote, were there people who did not make it, you interviewed them, then finally realized that, okay, they don't fit into the list of traders who you want to profile? Were there such names? And
yeah, so you're talking about people that I interviewed that I didn't use?
Yeah, you didn't use.
Yeah, so basically, I live by the trader's premise of cut your losses short. And not only in trading, but it's in life. And so if I did an interview and I went through it and listened to it and read through it, and I said, there's just nothing here. I'm not nothing here, but there's too little here that's worthwhile. It's just not interesting. It's not useful. Maybe the trader's approach was too esoteric, whatever. Could be any number of reasons. And said I in some cases, maybe I even traveled to a different country to do the interview, but if it's just not good, cut your loss short and just better off not to use it than diminish the quality of what's used.
Makes absolute sense. So, and how would you evaluate their performance? Was it publicly available or what was it like?
Sure. So I always had to know that the records were real. In some cases, it was easy. For example, Michael Marcus, he was with Commodities Corp. I knew the firm, and it was well known. His record was well known, and I got it, but it was verifiable through anybody in the firm and so forth. Somebody like Paul Tudor Jones, he had audited track records, and different people had so for each person I had to get a track record that was verifiable in some ways. And occasionally, if for some reason, like if it's a proprietary firm and we just can't get a hold of the actual track records, but then speaking to enough people that would verify, yeah, this guy's the real thing and he made $100 million here or whatever it was. So I would have to verify one way or the other.
Makes sense. Now, talking about verifiable records, were there records which you saw and, you know, which was so out of the world in terms of returns that it was hard for you to kind of believe that someone really generated those, returns?
Yeah, all the time. And even in the most recent book, I mean, these records are crazy. In fact, the next generation book, track records there, some of them are probably the best I've ever encountered. There's one trader who turned a $40,000 account into 500 million. And, there's all sorts. There's one trader who had no losing months. Well, in 11 years we could verify, and by his word, before you manage money for a family fund, so records weren't available. But I have no reason to not believe him that he had no losing months then either. In any case, those type of records they are totally hard to believe, and yeah, they have to be verified. In one case, one of the traders had a year return that was so crazy. I mean, it was so outlandish that we always get the track records, but some of the brokerage firms were offshore brokerage firms or whatever. So look, this 1 year we can't do this unless you get this audited by a named firm. So one of the top 10 auditing firms did audit it, and in fact found out that the percent return for that year was even higher than he had calculated. Yeah. So we ended up putting them in a book. And a lot of people don't believe. A lot of people are skeptical that it's true. But we literally went to the lengths of demanding that it be audited before we could claim that we just didn't feel comfortable using it. There's another trader who's also had a track record. This is the opening of that chapter, and it's I'm paraphrasing, maybe it's exact. It's something like Jason Berry's track record looks a lot like Bernie Madoff, with a few exceptions. It's real, it's better, that type, and so literally he has his equity curve looks like Madoff, a little smoother and more return. So, a greater percent return. So those type of records are of course hard to believe, but of course, we got all his brokerage statements and verified.
Talking about Madoff, I mean, I'm just going off track a bit here. But then, was there, before the world recognized it was all a Ponzi, what was the word on the street? Did people really believe that it was a kosher firm, or what was it?
Well, Madoff, he came from I guess he was chairman of NASDAQ at one point, and he had a reputable, he had a reputation, and I guess people wanted to believe it. Although I will tell you that two of the market wizards I interviewed over the course of my books basically called him out. Well, in one case, called him out in print well before that came to light. And in the other case, it was at Thorpe, he kept it quiet because he had a client who asked him to examine Madoff's record, and he flew out and he got boxes of the client's statements, and he quickly determined for scores of reasons that this was an absolute fraud. And this was way back. I think he determined that in the late 90s, if I'm correct. And of course, you had the famous instance of the Wall Street, of the article, Marco Polis's article, where he listed everything years before. And it's extraordinary. He spelled it all out years and years before. And somehow the SEC had actually went in, and with a blueprint of all the things that were wrong, somehow didn't blow the whistle. I don't know. I can't. I can't for the life of me figure out how somebody could have that article and supposedly be in a profession of checking out, of checking whether traders are, results are legitimate, go into the firm and not. I mean, I can't even make up a story how they didn't know something was wrong.
Got it. Got it. So I have talking about market visits. I have another, two more questions. One is whether people who were extremely successful and made it to the book, but years later they failed in a sense. They blew up. Whether someone who fits that profile.
Yeah. So um, I usually don't know the track records of people when they, after I interview them. And in some cases, like, where I will know because they continue in the business and, they, that they remain, that they continue to be very successful and stuff like that. So when they're running hedge funds and they stay in the business for a long time, sometimes but a lot of times I don't know what ultimately happens. And certainly in some cases, they do go through losing periods where I might know like somebody like Richard Dennis, who first of all, it should be said, Richard Dennis is somebody who started with a few $100s and made 200 million. So I don't care what else happens, but anybody takes a few $100s and turns it into $200 million, that's a story, no matter what. Then I know he did run a couple of hedge funds and he lost, although he was, in one case, it was a matter of his making money. And then most of the investors came in when he was at the height, and then he lost it all back and whatever. But ultimately, I know, at least for the period, a number of years after, I don't know, 4 or 5 years after I interviewed him, that he had a difficult time in the markets. But what ultimately happened with him, I don't know. And in most cases, it's impossible for the traders to continue the type of records they have. I mean, if I say Marcus went from 30,000 to 80 million, he can't keep, you can't keep on compounding like that. But I don't know what really happened to them in the years after. So certainly it's possible. I wouldn't say, well, anything is possible, but it wouldn't be a matter of blowing up. I would say it might be more a matter of not being able to replicate what they did, and maybe in some cases even giving back some money. But ultimately, I would imagine they all ended up way ahead of the game.
Hmm. Interesting. And there's another question that comes to my mind. Now, when you look at all these traders who are obviously successful, and in the world of trading, we generally talk about having simple ideas or strategies or complex ideas. Now, on the spectrum of simple to complex, how would what's your take on the kind of strategies which made them successful?
It varies. They all use different approaches. The amount of variation in their approaches is really amazing, considering you would think that, gee, a lot of them use the same but they didn't. They all had very individualist approaches, some much more complex than others. But even when they don't seem so much complex on the surface, they a lot of times rely on a lot of sort of intuitive experience, and that's kind of hard to put your finger on. It's complex in the sense that it's based upon their having studied and watched markets intently for decades sometimes. So the approach might sound simple when you explain it, but it's a matter of seeing so many situations and being able to discern which are the legitimate ones and not. So I would say I would come down that overall it comes closer to complex, not complex in being a list of difficult formulas and whatever. Although for some traders, of course, it is with somebody like a Thorpe or whatever. But for most traders, it's not complex in that sense. But there's a lot of elements involved, and to pull it all off, and it's not like somebody sitting there for a moving average.
Crossover.
Yeah, crossover moving average system and becoming a market wizard.
Got it. So what you're trying to say, Jack, is there's a lot of nuance to it. It may not skewed towards being very simple, but there's nuance to it.
Simple ideas may underlie the approach, but simple ideas by themselves will never give you a great track record. They may give you you could come up with a simple idea generated trading approach that is profitable, but you won't get market wizards. Market wizards don't, there's no market wizard I can think of that had a real simple approach, and that was, I mean, even if I think of somebody like in a recent book, Christian Kulamaji, who was a trader who started out with a $5,000 account, got a peak of 100 million, then had a big drawdown, but still has, scores of millions ahead. Uh, anyway, he basically came down, ultimately evolved using three trade setups, all which can be explained, and in fact are explained and are illustrated in the book. This latest Market Wizard book is the first time I actually used charts in a book. And he combined it with money management rules. But so it's not complicated in that sense, but still, I think to pull it off, there's something that you still have to have your own sense of which situations qualify for that approach, which don't. How do you utilize other information, like whether the market's in a bear or bull phase and things of that nature? So the approach can be explained, and somebody can read the book and almost try to replicate it. But I still think to get extraordinary results, it takes something ineffable, something a little indescribable that is particular to the person.
So, of the 80 odd, wizards that you interviewed, how many of them would be systematic, fully systematic, and how many of them would be fully discretionary, and how many would be in the middle?
Okay, I would say virtually almost all of them are discretionary, with the
Oh my
exception,
goodness. Okay.
yeah, and I'll explain that in a minute.
Mhm.
With the exception of people like Ed Thorpe or D.E. Shaw. These are kind of quant trading firms, but they're not systematic in the way people think of systems so much. In Thorpe's case, it's systematic in that he developed strategies before the rest of the world figured it out. Like he was the first one, to my knowledge, who figured out how to price options before incidentally, before Black and Scholes published their famous paper, and he was able to print money because he came up with a very similar formula to theirs, and was the only one using it. So, and then when option pricing became kind of known, he went on and I know the next strategy I don't know if is convertible arbitrage. He came up with that strategy. He came up with statistical arbitrage. All of these are strategies that ultimately were then followed by scores, if not hundreds, of different hedge funds. But he was the first, and so that was systematic. But it was systematic in kind of inventing a strategy that recognized an efficiency in the markets that nobody had recognized to that point. So it's different than what people think of systematic. Somebody like D.E. Shaw has a firm with like hundreds of quants, and they're trading tens of thousands of securities, not only the outrights, but options and convertible bonds and all sorts of derivative instruments, and the relationships of those, and probably have scores, if not hundreds, of systems operating, each with a small edge. And again, it's systematic, but not systematic in the way the trading community thinks of systems. So I can't think of a single trader I interviewed that used a simple. Now, somebody like, well, I mean, bottom line, let's just leave it at that nobody that I interviewed used a simple system per se that I can recall offhand.
So I'm trying to understand something over here. So when you say nobody was fully systematic, does that mean they did have rules, but they did not apply those rules blindly across?
Systematic in that sense. I mean, there may be people who had rules, and those rules drove them, but it was not really systematic in it being generating an absolute buy and sell. Like a single set of rules that generated a buy and sell signal. It wasn't systematic in that sense. Oh yeah, so like somebody like Ed Seykota, who was one of the very early trend followers. I mean, one of the very early ones, way back, and back in the '60s, even, starting out. And so he used systems, and then he went to the '70s, where actually simple trend following systems did work very well. But there's a line, there's a line in the book where he's listing the important rules, and that he lists like 5 rules, and I think number 4 is always follow the rules, and then number 5 is know when to break the rules. And I believe the reason his record was extraordinary is because he didn't follow them. He had systems, but he kind of knew when to not follow the rules. So like I say, I can't think of a single interview in any of the 6 Market Wizard books where, well, one exception. Yeah, I can think of one now. Previous book, Unknown Market Wizards. They were all discretionary traders, except one trader was systematic, and he literally, he was systematic, and he did use systems. Now the thing though is, he used systems, but he kept on changing the systems. So the original systems he used, it was very interesting. At one point, sort of, he had done very well with these systems, and then he hit this period of 4 or 5 months where they just started losing money, and he decided they weren't working anymore, and he started using a different set of systems. And I asked him, what happened to the original combination of systems that you made your initial money on? And he said, oh, they just continued to lose. And in fact, he showed me, because he was a computer guy, he had every system he ever traded on his computer, not only while he traded it, but, still in current time. So he ran the system. He showed me the combination of systems, and it was like a mountain chart, both sides. In one case, it went straight up, and then in the initial part where he started getting his losing months, and then after he's abandoned, it just went straight down. So had he stuck with his original systems, he would have wiped out. So yeah, he was always following systems exactly, and he computerized them. He got signals on them, but he was always changing the systems. So again, it's not what people think of as systematic.
Makes sense. Makes sense. So that brings me to the question. So which means they had, some kind of an intuitive understanding of when to, as you said, break the rules or stop the system or change the system.
Yeah, I think that's important. I think that's part of it. I think part of it is they have a good intuitive sense of when something is not working. Or there doesn't have to be a system. Could be this purely discretionary trader who's using a certain approach, and if the approach isn't working, they may recognize that the market's out of phase with that approach, and they stop using it. Maybe they go back to it at some point or not, but it's still, no example can I think of where somebody started with a system like a buy sell system and stayed with it. Yeah, you can find people out there that have long-term track records that are successful, that have done that, and have done well. I can think of somebody that I didn't do, somebody like Bill Dunn in currencies. I haven't seen him for a while, but I know, he's been around forever. He might have a 40, 50-year record, and he's made good compounded returns over time. But you have to be willing to live with 40, 50% drawdowns, not once or twice, but repeatedly through. Yeah, so there are people out there like that. So you can get people who are profitable over long periods of time using the same system over a long term. But if you look at it in return risk terms, it's never going to have a very high return risk. It becomes a matter of, those are people who are able to live with and stomach very, very large downside volatility, and ultimately come out ahead. So, that's one way. But again, I'm never putting somebody in a book that has really large returns, but their risk return did have a sharp. I'm going to say sharp. I don't use a sharp ratio, but because people relate to it. But let's say people who have a sharp ratio of less than 1, but have really high compounded returns. So there are a number of people out there, but I'm always looking at people who have much better return to risk.
Going back to the question of intuition, now, the little that I can understand is you can develop an intuition for a given market. Were these people trading a set of few markets because they traded those markets and they developed a sense of how those products or markets moved, or what was it like?
Yeah, it's not necessarily. Not necessarily. I'll give you a good example of intuition, and I'll use Michael Marcus here. Okay, there was one point where um, he was like long soybeans, and he was long, and in commodities and physical commodities, there's a limit to how many contracts the CFTC allows a trader to hold. So, and it's a large position, but he had a large position, but he didn't own the actual limit that he could own. And one day, a report comes out that it's very bullish for soybeans, and he's kicking himself. He's kicking himself because he doesn't have the full position, the allowable position. So back in those days, the traders used brokers. He puts in an order to buy as many contracts as he's allowed to hold for the next opening, and he gets filled. Oh, and he gets filled. Here's the thing: he gets filled that next morning. Now the expectation was that the market was going to be up several limits in a row. He gets filled right in the opening, and it hits him. The market was supposed to be up several limits. I'm getting filled on my entire position. And he realizes he got it backwards. He's not only does he sell what he added, he sells wildly. He sells an entire position and ends up, he goes so wild selling that he actually ends up net short for the day. And he said unintentionally, but he says that was the only time in his career where he made money by a trading mistake. But that's intuition. Now it's intuition. It's just hit him that the market action is opposite to what it should be for his position. That's a perfect example of intuition. Now, it's not some mystic feeling. It's he's had enough experience with how markets behave to know that is a clue that something is wrong with the position.
But it need not be because the fact that they traded the same product over years.
Not necessarily. Yeah, I think that type of market action would have applied to different markets. It's not just that you trade one market and get to know that market very well. In some cases, people do. There are instances where people, become kind of very expert in one market. In some cases, they can only trade one market. Somebody like Tom Baldwin, I think I interviewed in Newmarket, was the largest pit broker for T-bonds, trading his own account. Trading size larger than some of these large houses, right? But he's just trading T-bonds, and that was his instinctive knowledge of that market being in the pit.
Talking about intuition and expertise, I have another question. Over years, have you seen a minimum number of years that someone needs to put in to develop that intuition? Have you seen a pattern there?
Yeah, I would say that, and that question has come up in a number of interviews, and I think the general answer is probably a minimum of 2 or 3 years, and frequently longer. I think traders would have a consensus that it's at least 2 or 3 years, and it could be longer.
If you have to reflect on your own ability, when you looked at, at some point in your own career, you would have had this sense, I think now I understand this market a little better than what it is. So how long do you think it took for you to make sense of markets?
Yeah, so for me, I should make it clear that I'm not a trader per se. I've never traded for a living. I've never traded full time. I was always doing other things. Trading was always kind of sometimes on, sometimes off hobby, depending on what my time schedule, my interest, whatever. So there are large segments of time where I didn't trade at all. So for me, I don't I would preface it by saying that, hey, I'm net profitable only because I have enough experience, but I'm not a good trader, and I'm not a model for anyone as a trader per se. I basically try to capture the wisdom of other people who are traders, and I consider myself more a writer than a trader. But just having said that, for the first few years, well, I traded absolutely very, very small, a couple of $1,000s at a time, and lost that several times. The point where I became net profitable when I was trading was when I started using charts and money management. But that came probably 6, 7, 8 years into the business. But again, I wasn't trading 6, 7 years. I was just periodically doing, some trading, and then, I'd risk 2,000. I take $2,000. If I lost it, I'd walk away. I'd come back in a year, things like that. So I wasn't a continuous trader. So it's hard to answer that in terms of time for me, because again, I'm not a trader. For a trader, for somebody who actually says, that commits themselves, like the people in my books, and certainly in this recent book, that commit themselves full time to doing this, that there the answer I think is 2 to 3 years minimum. Some of them occasionally you get somebody who gets it within a year, but that's more the exception.
Okay, cool. Another question. You observed obviously so many people. To what extent do you think this intuition or this ability to understand a given market or understand trading is a skill which can be developed, or do you think that there's something natural about this? It's more of a nature versus nurture problem, which I'm trying to get to. So can we say with the right kind of mentoring, with the right kind of being in the right kind of environment, you get to learn? So what's your take on that?
I think certain people are just, their emotional makeup is just much more attuned to being a successful trader than other people. Some people, just like not all people are born to be sports stars, right? Only certain people with the right physical attributes. Yeah, you always have to have a lot of work and commitment, but still, it's only certain people that have the right physical makeup. When it comes to trading, it's not so much physical makeup. I think it's emotional makeup. And I think only certain people have the emotional makeup or innate skills that allow them to really excel. Uh, it doesn't mean that only a select few can be profitable, but I think it does mean that only a select few can be wildly profitable, like the people I interview. Now, what they do is still important, and you could still learn from that. And certainly, I've met hundreds of people at least who've told me that they became successful because they have stuff they learned from the books, but but they but the skill required to be an exceptional trader, I think, is at least partially dependent on some innate abilities that not everybody has. For example, one trader in this current book mentions that from an early age, he was always able to be calm in terms of any crisis. He never got flustered. He was always dead calm on everything. And that type of ability is a big attribute. Another trader who kind of trades multiple time frames and multiple systems at the same time, and is kind of focused on multiple strategies at the exact same moment, says he's always had this ability to multitask. It's just some innate skill he had. And again, I think a lot of this stuff is inborn.
But then, talking specifically about trading or related skills, I mean, did these traders develop it by themselves, or did they work with others in a team? Generally, what's been the story like?
I think in most cases, traders developed it by themselves, but they may have had a mentor they learned from. So Marcus learned from Zerodha, as an example. He developed his own approach, but his influence was seeing he was losing money or he was getting out of winning trades that should have gone a lot further. And at the same time, Zerodha's there, you're just making more and more money. And he eventually, many cases, people have mentors they learn from. A couple of traders in the current new generation book started out with prop firms, and like one trader mentions that there was the best trader in the firm when he joined, and that best trader, this firm's in New York, and he's a young guy. and everybody wants to be in New York as a young person. And this best trader had a family and moved out to Princeton and needed an assistant. And he volunteered because he wanted to be with the best trader, who he then admits he learned his initial strategies from and was instrumental to his ultimate success. So finding the right, but they all develop their own, even if they have mentors, it's not a matter of copying the mentor. It's a matter of learning from the mentor and adapting what fits for them and then developing their own strategies.
Is it true even for the new ones? I mean, the ones in the new book, was there something different that you saw with this?
Well, a lot of the things are similar. There was one very noticeable thing, or a couple of noticeable things that were different. One was that this is the first book where a few of the traders started using a strategy that was kind of philosophically in opposition to what virtually almost all the other traders in previous books had done. So in previous books, regardless of whether they were fundamental or technical or a combination of the two, or short term or long term, or traded stocks or traded futures or traded options, whatever it was, typically, if you boil the strategy down, it had elements of a positive asymmetry, combined with money management, had elements of a positive asymmetry strategy. In other words, they were successful not because they won most of the time. They were successful because their strategy gave them winners that were much larger than their losers. And ultimately, like I say, no matter how different their approaches were, they seemed to share that. In some cases, to an extreme sense, but let's say in all cases, that was a characteristic of their win-loss profile. Not a majority of winning trades, but winners being larger than losers by a significant amount. Okay, but in this book, you had a few traders who started out using a strategy of selling small cap stocks. Now, that is kind of a poster child for a negative asymmetry trade, because if you're right, what's the best that can happen? The stock goes to zero. So it's a limited amount, right? And usually and a lot of times these are single digit, these are stocks trading under $10. So it's not like you have a huge downside potential. On the other hand, these stocks are often, a reason they're going short is because they've done the research to know that these stocks are worthless and they're being pumped, and they know it's going to go to zero or thereabouts ultimately, but it's the interim ride. But if these, and they'll be selling it when it's up a few 100%. But the point is, if these stocks are up a few 100%, they can go up another few 100% as well. So the strategy has this element of, they may be right majority of time, but if they're wrong, they can lose a lot more than they make on the correct trade. So this book was different. It's the only time I've run into traders using clearly negative asymmetrical trades. Although they didn't continue to do that for their career, ultimately they all evolved into doing other things. But they got started that way, and that was different.
Got it. Interesting. So a couple of other things in terms of to what extent, when you talk about this intuition that people have, or even generally, to what extent did you see success in trading converge with the idea of understanding market regimes? So how important is that?
Yeah, it depends on the strategy, but for some strategies, it's very important. So the trader I mentioned, who went from 5,000 to a peak of 100 million, he used different strategies for his career, but the strategy that he was using in 2020, 2021, which was super successful, by mid to 2022, that strategy turned exactly opposite. It became a continually losing strategy. And he recognized it eventually, but not soon enough. But what he did recognize was that strategy was only valid if you knew there was a strong bull market. So that was the catalyst from coming up with simple rules to define when we were potentially in a bear market and not to trade in those periods. And so that's a good example of where market regime is very important to success. So That then became part of his strategy to define the regime and only use certain approaches, certain setups when they were not in violation of the premise that the general market was in a bull phase.
And going back to the point of intuition, is market regime a part of the intuition which we spoke about earlier? Is that
Um, I think in some cases, it's a trader's sense of what kind of market we are in. In other cases, it's like in the trader I just mentioned, he just uses a simple moving average to be an early sign of when the market regime might change. So it depends on the trader.
got it? And did you find? I know you've co-founded FundSeeder, so there are a lot of traders you would have observed from there as well. Did you see anything different about those traders, or in terms of those who were successful? Was there something common that you saw, or this was a different group?
Well, their approaches were different, but first, so with FundSeeder, some of the traders that were in unknown market, which just came through people who had applied to FundSeeder. I found them that way. I think I'm trying to think in a recent book, I think there may be a trader as well. I'm not sure. Uh, I offhand can't remember. I think there is maybe at least one or two that might have come through that. And I, like all the traders are different. And the last two books have focused the last two books have been 100% about solo traders. So it's not not a question of traders that came to FundSeed. It's a question of solo traders, people not managing other people's money. Yeah, so they're different, but I think in every book, the traders are different from themselves and different from other traders. So I don't know if it's a matter of solo traders being different than traders who ultimately end up running a hedge fund. They're obviously different in the sense that to run a hedge fund, you also have to have a side of your personality that wants to manage a large business and can do it successfully. So that's enough. But when it comes to the trading itself, I don't know if the class of solo traders has things that are specifically categorically different about their personalities, other than managing a business.
So one thing which comes to my mind, Jack, is when it comes to solo traders, we call them retail traders in India. So being well capitalized is one issue. So if you don't have enough money to trade, obviously, and you can't trade. So do you see the solo traders, successful solo traders that you have observed, were good with money management or capital management? Any thoughts on that?
Okay, there is actually now that you asked that, there is a difference that comes to mind. Not for all of them, but for for a group of the solo traders, they are using approaches that don't scale. The trader I mentioned in the current book who has literally zero losing months, um, he's he's literally making 700% a year, but that's only because he's trading. Well, part of it is his approach doesn't allow to scale large, but another thing is that he can't tolerate any losses, so he just has no comfort level of trading any size. So he's always trading like $100,000 or less. And it may not make any sense, but that what works for him. So every year on that 100,000, he makes $400,000. But there's no compounding going on because he's always trading a small amount. So not only couldn't he run a fund, even if he wanted to, his approach doesn't allow it. But even for his own account, he doesn't come remotely close to what can be traded. So that's an aspect. And as I mentioned, the selling small cap stocks, that's something a trader can try only realistically if they're trading a relatively small account. You can't manage a hedge fund. Hedge funds will never look at that because they can't do any size in that type of thing. So some of the strategies that can be used and there might be profits in there for the individual trader can't be utilized by hedge funds.
Got it. So I have a question in terms of back to solo traders here. Now, are there certain characteristics of solo traders that you observed who go on to become fund managers later. And so, is there something that you've seen?
Oh, sure. I mean, sure. I mean, you take some. I mean, lots of them. Take classic example. Take somebody like Bruce Kovner. He was a solo trader, but ultimately went on to found Caxton, and I don't know how many tens of billions Caxton manages. But there are lots of traders, across the books who started out as almost all of them start out as they almost all start out as solo traders. So all the guys who end up with hedge funds, um, basically even they started out as solo. Very few traders start out as a hedge fund.
So, what was it about them that helped them scale their strategies?
Well, they just, I think it takes a certain type of personality that wants to, first of all, the approach is scalable. Okay. So it depends on the methodology, but a lot of approaches are scalable. So assuming it's scalable, they have to then want to, so there are traders who just want to trade. They don't want to be, they don't want to manage a business. They just want to trade. Sometimes they'll hire other traders to manage their money, but they're just not interested in running a hedge fund. And other traders say, I've got a scalable approach. I want to be a big hedge fund, and that's something that is a goal of theirs, and they can feel they can do it, and they have an interest in doing it. So that becomes a personality difference of does somebody want to be just a trader, or do they want to be a trader but build an organization?
Hmm. So, if someone's, there are a lot of people in India who are looking to start trading, or young, who are getting into trading right now. So, if someone like that asks you a question, um, what are the things that they could focus on in the next couple of years, irrespective of the markets? What would those skills be?
Yeah, so I can give some good advice here, worthwhile advice. Uh, First of all, you got to develop some sort of approach before you start trading. Uh, and if I ask somebody, what is your methodology? And they can't answer the question, they're not ready to start trading. Now, to develop a methodology, you've got to do research, independent research, read books. You're not trying to, don't look to find something, somebody hand you something on a silver platter. You can get ideas out of books, you can get ideas from the internet and all that, but ultimately, you have to find things that you're comfortable trading, that makes sense to you, and that if you experiment, and initially, while paper trading is vastly different than real trading, but initially, at least experiment with paper trading, knowing that there's a difference. But if you can't make money paper trading, you certainly can't make money real trading. Don't fall for although you shouldn't fall for the assumption that because you paper traded successfully, you'll be successful. But at a minimum, you have to have an approach that at least on paper seems like on balance, it can make money with reasonable risk control. You have to have risk management rules that you have in place before you start trading. And then the other thing I would say is when you feel you're ready to start, always start with a small varies from person to person, obviously. What's small for one may be large for another, but always start with what for you is a relatively small amount of money that you can lose and it won't change your life. Uh, a lot of people make the mistake of taking their savings and opening an account, and then they blow it all and they're out of the game permanently. So recognize that even great traders end up wiping out sometimes multiple times before they're successful. So there's a high chance that when you start, you're not going to be successful. So make sure that the amounts you use are small so the damage you do will be limited. And what I would say is define that small amount, open an account, define an amount where if you lose a certain percentage of that, you stop trading, go back to the drawing board, come back in a few months when you feel ready again. But that way you'll have the opportunity to try again.
Got it. Got it. Jack, have you tried using AI, and what do you think, the world would look like? And by using AI, would do you think people would be able to trade better, or how do you see things changing with AI now?
Okay, so one thing that's obvious, you don't have to be uh, particularly insightful to understand this, is you cannot underestimate the power of AI. Um, if for no other reason now that we've reached a stage where AI is developing its next generations, so we are in an exponential growth phase of the power of AI, and where the world will be in 10 years, even in 10 years from now, is probably somewhat almost unimaginable, because when you get to exponential growth in anything is the most powerful force one can imagine. People underestimate how powerful exponential. So I don't want to underestimate what AI can do, but I will say that there is one structural difference about markets and everything else in the world that still leave open hope for the individual trader, and that is everything else. I don't care if it's science, anything to do with any science-oriented thing. It follows the laws of physics. It follows laws of biology. There are set rules, that are true, and they don't change. I mean, the planet, planetary force motions don't change. They're always the same. Uh, things, the calculations make something like a weather system is enormously complex, but each of the individual components uh, follow certain physical rules. Those physical rules don't change. Now, when you put them all together, you get enormous complexity. But the point is, because each of the elements uh, follows certain physical rules, you can get AI improving something like that dramatically, or in, say, developing medicines uh, where there are such an enormous amount of possible protein combinations or whatever. Um, but AI can see patterns that humans can't, and so you can speed that process up a lot, because the basic science, the basic biology doesn't rules don't stay the same. Now here's where markets are different. Markets don't stay the same. Yes, they always reflect human emotions, but that has a lot of variability to it. And yes, human emotions drive markets, but again, a lot of variability. But the way markets behave to any input changes. Take something as simple as stocks and bonds. There are times when they're positively correlated. There are times when they're negatively correlated. There are times when they're uncorrelated. So, so you can find patterns in the past, but those patterns they're not. It's not like a law of gravity where it stays the same. Those patterns can change. So I think uh, AI can come up with, because of its power of pattern recognition, there probably will be very successful systems that will be developed with AI, and they may already be operating, but um, but it doesn't rule out the possibility of individuals coming up with approaches that work, because the markets can't be reduced to strict formulas.
Makes sense. Makes sense. So that brings me to the end of this conversation, Jack. So I have a couple of last few questions. One, have you explored looking at traders outside of, let's say, UK, Europe, and US? Let's emerging markets like Brazil or India as well. So any thoughts on that?
Yeah, so I have interviewed, there have been a few traders. So in this latest book, one trader is Swedish, uh, one trader is Singaporean, uh, one couple of few of the traders are UK. But you mentioned UK, but I'm saying so. Out the last book, there was a trader from Czechoslovakia. So yeah, so I have, and of course, the last book also had a number of UK traders, but there have been a sprinkling of traders from countries beyond US and UK, but only a sprinkling.
Hmm, got it. And what's next for you, Jack? I mean, of course, you had the recent book come out, but then is there something else? Any other project you're working on that you look forward to?
There's when we did this last book, we recognized early on that we probably were going to have too much material for a single book, based upon the interviews we had done and had agreement for interviews to be done. So we thought about it and came up with a solution, which was to make this book solo traders, the next book hedge fund traders. So while I didn't go into this planning to do two books. The fact that that we have to divide it somehow uh, sort of almost ties me into then doing the next book. Some of the interviews which have not only been done already, but which were already written up and weren't used in this book because we had to make a thematic distinction between the two. So there will be another hedge fund oriented market wizards book, in a year and a half or so.
So beyond that, what keeps you busy, Jack?
Oh, well, I'm retired. Other than writing books, I'm retired. And I have, whether depending on the season, if I kayak or cross country ski or hike, you know, that's my main avocation for daytime, and is to do some physical activity being retired, but I still write. So I still do writing, and occasionally I do trading on and off, and when I trade, that takes up some time. So I used to trade almost only futures. Now I'm trading almost only. I still trade futures somewhat, but I trade mostly stocks simply because there's a lot more choices. And
Any particular style when you're looking at, is it more trend following or?
my own approach, again, I'm not a great trader, but my own approach, all my trades fall into one of two categories. They're either trend oriented, or trend anticipatory, or counter trend, and they're obviously different. So for a trend type trade, I might look for a market that is in an uptrend that consolidates, and I expect it to break out on the upside, and I may go long the consolidation with a stop below it, that type of trade. For counter trend trades, I will, when I look at a chart, often I'll look at a 10-year history to start, and I'll look for points where there are a number of relative lows. Sometimes it's a concentration of relative lows and relative highs in a certain zone, and that is always well below the market. And I'll put in an order to literally buy one contract, one share in terms at that price, and I simply do that as a signal. And so when I see a one lot filled, I then look at the chart, and I know one thing, that particular stock is is really down very, very sharply, and two, that it's in an area of some support. So there, it's a counter trend trade where I go long, anticipating that the odds are better at that zone to get a bounce.
Lovely. Thanks so much, Jack. Thank you for your time and sharing all your ideas and experiences. And, it was lovely talking to you.
Thank you. Thank you for your questions.
Thank you.